Hello, everyone, and welcome to our April webinar for our Mortgage Quality and Compliance webinar, or committee. I'm Susan Milazzo. I run the California MBA. I'm very happy that you could all join us today. Just a note that today's presentation is being recorded and it will be available on our committee webpage as well as on our YouTube channel. So if you want to subscribe to that, you can see a recording of this after the fact or share it with colleagues perhaps that you work with. Before we get into today's presentation, I'd like to share with you some information on a new opportunity that we have at the California MBA, which is our Operational and Compliance Forum. So we've had an executive forum that's been going on for several years at C-level executives that meet once a month to talk about just top-level issues that are facing the independent mortgage banking industry. And this year, we are adding on to that whole program, which is a separate series for operational and compliance folks in the industry. So it is designed to give leaders, an opportunity and a forum to talk about the issues that are top of mind for you in running either operations or compliance for an independent mortgage banking organization. Lots of things happening, fair servicing, and things we're talking about today. But in addition to having speakers that are confirmed on a particular topic, you'll also get a chance to just have conversation and bring up the questions that you're having in your own company. So the forum meets monthly via Zoom, so there's no travel involved, but it does give you an opportunity to kind of network closely with people, your peers in the industry that do what it is that you do, which is so unique. So we've got a great first round of compliance people and operational folks that have participated and signed up for the forum, but I wanted you all to know that this is available to you. So if you're interested, please contact Deb Miagrassi. Her email is here on the screen. You can also email me directly, susan@cmba.com, and I will make sure that you're connected with Deb. She runs all of our forum series, and so she can provide you additional information about how to get you started with the forum if you are interested. So wanted to share all of that with you before we get into today's webinar. So with that, I will turn it over to our MQAC committee chair, Paula Lieber with CMG Financial, to introduce our MQAC sponsor.
Yes, thank you. And that forum sounds amazing. I'm looking forward to that. First off, we again want to thank our sponsor, Crosscheck Compliance, and our wonderful Monica McCarthy, which I'm sure everybody knows because she is the best networking lady. And Monica, I'd love to hear a little bit about Crosscheck, and thank you again for sponsoring us.
Great, thank you so much, Paula, and thank you to everyone. Crosscheck is a proud and active member of the CMBA. We have a highly qualified team of industry professionals who have broad and deep mortgage-specific experience. Hopefully, you know many of us. We provide a variety of services, regulatory compliance consulting, of course, QC, both pre-funding, post-closing. We do internal audits that you need, fair lending and also fair servicing, consumer loan reviews, commercial loan reviews, lit support, and we also recently started the due diligence work for securitizations. So our depth of expertise, our team has a lot of the certifications that many of you hold also, as well as being auditors. And we do partner with law firms and are doing more of that on the fair lending side so that those engagements are under attorney-client privilege. And I certainly love to network, so don't hesitate to reach out to me if I can be a resource to any of you, and keep involved in the MBA.
Wonderful, thank you so much, Monica. And for today, we don't have a legislative update this time, but very quickly, I think we've all seen the California CRA bill has taken a turn for the better. So thank you so much for everyone that participated in the Action Alliance, for sending messages to your representatives, and we were successful, and thank you so much, Susan and Pat, who's not here today, but thank you for all of your guys' work. That really helps us a lot. Now for today, we're so excited. The second half of our fair lending series We're talking fair servicing today. And today, Michael's going to introduce our speakers. Take it away.
Great, thanks. As Paula said, we're in for a treat today. We've got two amazing speakers as we finish up part 2 of our 2-part series on fair lending. Last month's webinar, we covered fair lending for originations, and as Susan mentioned, you can go to the website and download the recording and watch it on YouTube. It's a great, really informative webinar on fair lending. Today's webinar, we're going to be focusing on the back end of mortgage as it relates to fair servicing. I don't personally know a lot of fair servicing experts out there, and I'm really pleased to present these two well-known industry speakers ready to drop some fair servicing knowledge on all of us today. So the first speaker I'd like to introduce is Jerry Jameson of New American Funding. A little bit about Jerry. He's a seasoned mortgage compliance officer, having worked in the mortgage industry for more than 20 years and mortgage compliance for nearly 18. He served as fair lending officer, BSA AML officer, and privacy officer for several large and medium-sized independent and bank-affiliated mortgage companies. Having focused on fair lending compliance for most of his career, he's developed fair lending, UDAP, and HMDA programs, working with in-house and outside counsel for some of the top players in the mortgage industry. And joining Jerry today is MQMR's Scott Weintraub. Scott previously served as MQMR's internal audit manager and now is the VP of compliance, where he's developing new products within the audit, risk, and compliance space. Similar to Jerry, Scott brings 20 years of experience in origination and servicing compliance. He's created and implemented compliance management systems, policies and procedures, audit and training programs, and enterprise risk management frameworks. Since I personally know Scott, I'd like to point out that he's an avid lover of two things in life, one being the Los Angeles Dodgers, and the second one being everything related to Stanford. So gentlemen, I'd like to thank you for presenting today. I know we're in store for a really great presentation, so let's go ahead and get started.
Mike, thanks so much for that introduction. And Jerry, I can say it's such a pleasure for me to be on this with you and a pleasure to be here with everyone. So as you can see, we have an ambitious agenda for the rest of the hour today. And so it's listed here. Jerry and I are going to go back and forth, and here are some of the key topics we're going to be talking about related to fair servicing. So we'll talk about having consistent policies and procedures related to servicing, for particularly related to issues that could present fair servicing problems if there aren't consistent procedures. We'll talk about customer service calls that could come into your organization, collection calls that either would be outgoing or incoming. We'll spend some time on applications that come in for loss mitigation, including for loan modifications. And also, what about those applications that might come in after an loan's already been referred to foreclosure? What do we do then to make sure borrowers are treated fairly and equally? We'll also talk about a big thing, particularly that the CFPB has commented on a lot lately, and they continue to do, which is what about exceptions made either to terms or to anything related to fees or pricing? And what process do you have as a servicer for exceptions? And then how are you tracking all of this? How are you reporting on it? And with whom are those reports being shared? And what happens if there's an issue that's presented? What do you do about those, and how are you tracking that any changes that the company decides on are implemented and that they're successful to mitigate whatever the risk was that was presented? And so Jerry and I will also do our best to leave at least a couple of minutes at the end for any questions that I believe you can type right in to the chat box. So with that, I think we can go on to the next slide that I believe I'm going to turn it over to Jerry.
All right, thank you, Scott, and it is a pleasure, presenting with you on this very important topic. So just to get us started, so fair servicing, it's kind of the evil twin of fair lending, and essentially the same laws that apply to fair lending on the origination side apply to fair servicing. So the two big ones are ECOA and the Fair Housing Act, which I'm sure prohibits discrimination on the basis of a number of prohibited bases, most notably race, nationality, ethnicity, sex, gender, religion. I would also include in there sexual orientation and gender identification. It's not explicit in those two acts, but those are prohibited bases at a number of states with their laws, and also, in actuality, kind of de facto, those are prohibited bases in a COA in the Fair Housing Act, where they kind of correlate with sex or gender. So, this covers every aspect of servicing. So from, when the loan is first sent to the servicer, dealing with the customers, all the way to when the loan is finally paid off. And I will turn it over to Scott.
Thank you. And yes, Samantha, I think we're ready for the next slide. And so, yeah, thank you. So Jerry and I want to talk about, with all of these laws and rules out there, and I think while a lot of companies have thought about fair lending for a long time, servicing, as you said, Jerry, is sort of the other side of it that I think a lot of companies say to themselves, first, is this a thing, right? And if it is a thing, what is it exactly that we need to do to make sure that if any regulator were to come in, that they would also agree that as a servicer, you're treating your borrowers fairly and equally. So one thing is, when you think about your organization, if you originate loans and then service them, or if you have management and oversight over a sub-servicer who may be servicing your loans, to make sure that servicing is a key part and a core part of your fair lending program. And so what does that mean? That means, number one, it needs to be included in your policies and procedures related to fair servicing. And we're going to give a lot of specific examples of what policies and procedures that we're talking about. So just as a bit of a spoiler alert, if you're talking about late payments and there's a fee that could potentially be waived, that's an example of an issue that could present a fair servicing issue. Or when reviewing loss mitigation applications, it's what the outcome is, or if an application is incomplete, all examples of policies and procedures that you want to make sure are consistent for everyone. So what are some other things? We want to make sure that you've designated someone at your organization to be the person responsible for not only fair lending, but fair servicing. Someone like Jerry, for example, who it is part of their job, at least if not their whole job, again, to make sure that the policies and procedures reflect fair servicing, as Jerry said, at all aspects, from when a loan is boarded to when it's off the system. And at any time, you want to make sure that there is a forum at your organization to be able to discuss and present fair servicing issues, either with a board of directors, if you have one, or with executive management. Only by knowing what the risks are can you discuss them, allocate resources, and implement change to mitigate and hopefully eliminate those risks. Another big element is training, and we'll talk more about that as well, to make sure that employees know what can they do as part of performing their daily job tasks and duties to further your organization's fair servicing policies and procedures. And Jerry and I will also talk about data analysis. So as you're servicing loans, how do you know if you have an issue or not? How do you know if there's something you want to maybe take a deeper dive look into, or if there is some practice or policy or procedure that might need to be tweaked or changed? Well, you're going to know that by looking at your data. So you first need to know what you don't know or what you might need to know. And we'll talk a little bit about that. And then, as we mentioned, if you find an issue, to take action steps to implement change. So with that, I think we can go on to the next slide, which is the first thing, which is consistent policies and procedures. And so again, what we're talking about is making sure that, as Jerry mentioned, every stage of the process, your borrowers are treated fairly. And so where does that start? Once a loan gets boarded, the servicing transfer. As an example of an issue that could occur even as early as the transfer stage, might there be borrowers that have an application that was in process with the previous servicer at the time it comes in to your organization? You will want to make sure that all of those applications are considered, that you don't miss any. And as we know, with the regulations that have been enacted by the CFPB, there are deadlines for communicating a decision to a borrower that could be based on when the application was complete with the prior servicer. So there are time frames that you're going to want to make sure that you're looking at. And then secondly, to make sure that everyone who has an application, that it gets considered. How about payments? Are they applied consistently and fairly? If a partial payment comes in and you're putting those funds in a suspense account, are those being managed well? Once an amount comes in that covers a payment, are those being applied to that borrower's account so that fees may not be racking up for that borrower? And again, is it being done the same way for every loan? We talked about applications for loss mit or for a loan mod. We'll talk a little bit more about that as we go on. And also, again, waiving fees. If there's a late charge or a non-sufficient funds fee, if a borrower asks them to be waived, does your company have a policy in process for that? And is it clear, will every representative talking to borrowers know what to do, right? What the criteria is to waive a fee? Is it something she or he can do themselves, or do they need approval? And again, is it something that you can track and monitor, as Jerry will talk about later, to make sure that it is being handled the same way? So there, with everything that you do as part of servicing a borrower's loan, you want to make sure, again, that your policies and procedures are clear, easy to follow, and consistent, so that borrowers will not get different decisions for the same thing. So with that, we can go to the next slide. And I believe, Jerry, the next couple of slides are yours.
All right, thank you, Scott. And just to build on what Scott was saying, so training. So, this fits right in with the policies and procedures. So you have written policies and procedures to, limit your risk, making sure that everybody's following those and treating, similarly situated people the same. But of course, policies and procedures can just sit on a shelf by themselves. So you need training. And you really need training that is specific to fair servicing. So there's a lot of training out there that we all know that goes over fair lending. Where I work, we've developed our own specialized fair servicing training, which is something you can consider, or I'm sure there are some providers out there. Also, you want it to be targeted if possible. So, somewhat specific to pertaining to the actual work and job that people are doing in the servicing department. So, there's general fair lending and fair servicing training, but the more job specific training you can get, the better. Also training on what your company's employees can do to ensure fair servicing. So hopefully COVID-19 is near its end. We know that's been a hot button issue. A big issue that I think a lot of people are struggling with, or what to do with limited English proficiency customers. But you want to make sure and train your folks on treating them all equally and what your policies and processes are around that. So, could be, if you have a lot of Spanish-speaking customers, you would probably want to hire Spanish-speaking customer service folks. And making sure that you have things such as a language line, maybe, or service like that, because you definitely want to avoid any misunderstanding, which we all know can lead to complaints, and then that can lead to worse things. Also, make sure any efforts and just the communication with the customer, that you document that. That can be very, very important during examination. I've had somewhat of a long career, and I can tell you that when an examiner comes and is asking you questions about a specific loan and you have no really documentation, it really puts you in a bad spot. So the more documentation, the better. And I would definitely recommend training it higher and then doing it consistently, annually, or you could even do it in tighter intervals than that. And also, something materially changes that could impact how people perform their jobs that they need to know about. You may need to provide revised training at that point. So I think we can move to the next slide. Thank you. And customer service. So, you know, it's the same thing that Scott said. Are you providing fair and equal service to all borrowers? So every borrower is different in its own way, and you know, there's particular aspects of a borrower that you know, really only apply to them or a few people. But the main thing is, in general, you're treating similarly situated borrowers the same. So those who are in the kind of the same position, same circumstance, you're always treating those folks the same. So, you know, things you can do, SLAs for responses to borrower questions, looking at customer service requests for documentation, so on your payment history payoff service, payment options. So, you know, this is an important thing. Make sure that your customers fully understand their payment options. Not everybody, although most people do, pay, you know, through the internet. So you need to make sure that all the customers know what options are available. Are there free options communicated? And then, of course, on the escrow analysis, balance and statements. So you'll get, you know, a lot of calls about that. I know escrows confuses a lot of people. So, of course, you know, be patient and, you know, treat them according to your policies and procedures. Be calm. You know, one thing you can do this in certain circumstances is thinking about using scripts, at least in a limited sense. That way, when you're dealing with the customers, everybody's communicating the same message. But at a minimum, you know, I think some training on communication and some guidance is definitely in order. You don't just want to throw different people out there who are saying different things. And then dealing with forced place insurance and removal of mortgage insurance. So that's another touchy thing too. So, you know, make sure that your customer service people are trained on how that works and how to deal with that, and, you know, how to deal with customers on that somewhat touchy subject. I think we can move to the next slide.
Yep. Thanks, Jerry. And you know, before I get into collections, I think I just wanted to hit on a little bit a couple of the many really great points you made on the last couple of slides. One of them was about training, and you mentioned to ensure that that's happening for customers that may have the limited English proficiency, right? The LEP customers. I'm sure you do as well, Jerry. I continue to read more and more, particularly on the CFPB side, but how much of an area of focus that is.
Yes.
From a regulatory perspective, and how much they will be looking to make sure when they audit servicers, what are you doing for those borrowers? What are your policies around it? But then what is your actual practice compared to that? So I think, again, that was a really great point to mention that specifically. Secondly, you talked about when borrowers make payments or they're talking with customer service. And I can tell you, when MQMR is out doing risk assessments and internal audits of companies and we're looking at their servicing, there's real life examples of what you were just talking about. For example, imagine, as a regulator might do, they're listening to customer service calls, right? You give them the recordings, they're listening to calls. One borrower calls in and says, I'd like to make a payment. Can I make it over the phone? And before that borrower is about to be charged $8, $10, whatever that fee might be, from the servicer, the customer service rep says, well, you know, Mrs. or Mr. Borrower, you could go on our website and make that payment and there would be no cost, right? And so the borrower might hang up, make the payment over the internet. Or another borrower calls and talks to the customer service rep next door, right, to the rep that answered the first call. And the borrower asks the same question, I'd like to make a payment over the phone. And the customer service rep says, okay, takes their information and the $10 fee is charged. Now that may, in a one-time example, $10, that isn't that much, but if that happens a lot, if, for example, data would show that there are a lot of people that might be in a protected class paying fees, whereas other groups are not paying those fees as often. So it's something, Jerry, that you mentioned that sounds so simple, could cause a real issue. And again, it goes back to what you said, not only having a clear policy and procedure. How does that work? A script, like you mentioned, is a great way to avoid an issue just like that, and to make sure people are trained to know what to do. So a couple of great points you made there. So then moving on to, another stage, what happens in collections when, unfortunately the borrower falls off the happy path that we all hope they stay on and they're in default? What happens then? So when calls are made, how is your process set up? Again, what are your policies and procedures around how often borrowers are called, what time of day they're called? We all know there are laws and regulations that regulate that, but within what's allowed, is it the same? Would borrowers who are in similar situations get called a similar number of times, or would there be evidence that some borrowers are being called more often? Or are some borrowers being called less often, and then they're being moved on through the process faster towards a potential referral to foreclosure without perhaps contacts being made as often or giving the borrower a chance, for example, to apply for loss mitigation? And so again, we've talked about fee waivers. So number one, what is your company's policy related to fee waivers? So first of all, do you allow them at all? And if you do, for example, what are the parameters around it? For example, one thing we've seen is a late fee could be waived once for a borrower. Well, if that's the company's policy, a couple things come to mind. One is, how is that tracked? To make sure that once a borrower's fee is waived, then it isn't waived the second time. Or you don't have a situation where some borrowers are having their late fees waived over and over again, while other borrowers are not because someone else is following the policy. Or something as simple as, how does your system reflect it? So if I'm a customer service rep on the phone and a borrower is saying if they have a late fee and they're asking, can I have that late fee waived? How would I know if a late fee has already been waived previously for that consumer, right? Especially if your policy is that a fee's only waived once, or only waived once, for example, in a 12-month period. How would someone know that? How is that tracked? So again, people aren't treated differently. When we talk about fair servicing, that's the crux of everything. When you have a policy and procedure, and then you look at your actual practice, are borrowers being treated the same? Or might borrowers get different results? Again, the same thing with letters. Are all your borrowers getting the same types of notifications within the same timeframes? How about when inbound calls come in? If a borrower comes in, they're proactively calling you. How is that handled? And again, would it be handled the same for any borrower who would call in? Are they getting sent to the right person? Are they getting sent to their single point of contact if they have one? Are the calls being answered timely? All of those different things. And then, as I mentioned, how is your system being updated? I think that's a key way to make sure that all of your loans are handled the same way, especially in areas like this where there may be discretion or an opportunity to make an exception. I think those are two words, if we put our CFPB hats on, that pique their interest the most. Exceptions to a policy or process, or if someone has the discretion to do something. I would say neither of those things are prohibited in and of themselves, but there needs to be a clear policy for what that exception or discretion could be, how it's done, what the criteria is, and are you tracking and reporting on that? So, Samantha, I think we can go on to the next slide. I think the next couple are mine before I turn it back over to Jerry. So collections is one thing. How about an application a borrower might submit or want to submit for loss mitigation? A loan modification, or maybe if that fails, or maybe a repayment plan, if those don't work, some other form of loss mitigation option. Well, the first thing that you'll want to think about is what happens, which I'm sure happens a lot, is if that application comes in and it's incomplete. So I'm sure many of you who are servicing loans have a list of documents or requirements to have that application be considered complete in order to start that 30-day clock to make that decision on the loss mitigation application. But what if it's incomplete? What is your process there for sending out a letter to the borrower that would tell them, here are the items that we're missing. We're going to give you 15 days or whatever the number of days is to provide us with the missing items. And if we don't get them, for example, we might close your application out and you have to start over if there's still time, for example. So that's one thing. And even if you have a process that would send out the letter timely to any applicant, who might submit an incomplete application, what happens then? What is your process for the follow-ups over those 15 days? And there's another example of how you want to make sure that different borrowers are treated the same. So if you had one borrower over here who got lots of follow-ups from the rep, from the SPOC or whoever it might be, calls, emails if the email's there and there's consent for that, all kinds of follow-ups to say, look, you're only missing one more thing or whatever, help you with this application, let's get everything in that you need. Or another borrower over here that maybe got one follow-up or no follow-ups maybe after that letter went out, giving them 15 days. And again, what's one big thing you could do to help with that? It's to track it and monitor it. So how is your company tracking incomplete applications? So A, to make sure the letter goes out. B, once the letter goes out, what does your company want? What does your company require for the number of follow-ups? And how are you tracking to make sure those are done and that they're logged in the system? So again, look at the point at the bottom. Do borrowers in similar situations receive the same outcome? In this situation, if it's an incomplete application, would borrowers get a similar number of attempted follow-ups, right? So if that 15 days goes by and that application did not get completed and your company wants to close out that application, are you confident that you took the same steps with each borrower? And again, that's something that can be part of your data analysis. But in order to do that, you have to be tracking and you have to have a process to know what it is that you want to track. And then you want to track it so that you can report on it so that you'll know if there is an issue there worth, for example, discussing in your committee that we mentioned before and maybe implementing some changes. Could be more training, like Jerry mentioned before, or a system enhancement. But again, do borrowers in similar situations receive the same outcome? So I think we can move to the next slide, which is, again, continuing with loss mitigation applications. So for example, now if it's complete, or what happens if you get an application after the loan has been referred to foreclosure? Well, as we know, that's a big deal, obviously, and there are regulations that surround that. And again, is your process, does it exist? Is it consistent to, for example, are you notifying the foreclosure attorney that you received a complete loss mitigation application so that, for example, the house doesn't get sold while you're considering the loss mitigation application? Or, as we know, at both the federal level with the CFPB servicing rules and at the state level in certain states, California, Nevada come to mind, that have their own laws for when it's required that a complete loss mitigation application be considered as you get closer and closer to that foreclosure sale date once it's scheduled. So, but what is your company's process? Are you, for example, following simply the CFPB's rules and or any state laws that might be overlaid on top of that? Or if you have a more open process, or you'd consider things closer to the foreclosure sale than, for example, the CFPB rules would require, are you doing that consistently? And that's the big thing, again, to make sure that if you consider this borrower's application over here, even if it's fewer than the days the CFPB says you need to, well, would you do that for this borrower over here? And again, it's making sure that borrowers in similar situations, meaning their foreclosure sale date's coming up, that they're getting the same outcome, that you wouldn't consider this person's application, but for the borrower in the same situation over here, you wouldn't. That's how potential fair servicing issues come into play. And that's how you could get a question asked to you, such as, why did this borrower get a different outcome? So with that, I think we can go to the next slide. And I think time to turn it back over to Jerry.
Yes, sir. Thank you, Scott. And just, I was just thinking about, we're talking about collection calls and customer service folks. And also, you're talking here about loss mit. So that's dealing with the customer over the phone many times. So one thing I just wanted to mention was call monitoring. Sample call monitoring is one way, to make sure that your folks are treating people equally and you don't have any potential, issue with discrimination or disparities in how folks are being treated. You can also do targeted calling if you do find you have a particular issue with a certain person. So just want to mention that. So exceptions and process. So Scott, I think, has covered this, done a great job covering this. We have fee waivers, the loss mint decisions, considering a loss mint app in advance of foreclosure sale, and then is there a consistent process? So, what's the process for requesting an exception, or what must the borrower ask for an exception? How does that work? What's your criteria for approval? Is it consistent? Say for loss mint, do you have, do you just, obey investor guidelines? Do you have any overlays or something of that sort? Is there discretion in making the decision? Another thing, of course, documentation is big. As we talked about, you definitely need that for an exam. They'll definitely look at your denials and see if you have any potential, disparities with that. And, the best way to defend yourself is if you have it documented. Why did you deny a particular customer? And of course, GMI info, that can get a little tricky on the servicing side. If you service your own portfolio, it's fairly easy. But if you're, if there's servicing transfers coming to your shop from another company, you may not have that GMI information. There's a way to, kind of account for that. It's called this Bayesian Method, where basically you look at the census tract where the property is, and it'll tell you if there's certain software that can do this, tell you if it's majority Black, Hispanic, or white, or whatever particular race, ethnicity. There's some issues with that, but I think the CFP I know has used that before, especially in auto lending. And one thing else I wanted to just cover here is I was thinking, exceptions in process. So I think a risk assessment is really important here, because if you don't know, where exceptions, where discretion is, you can't really ascertain what your risk is and what you need to monitor and test for. So I think that's an important thing, and it relates to the processes behind these particular exceptions. So kind of the way I do it is I look at a particular aspect of servicing, kind of what is the risk there. After making sure that I talk to people, read policies and procedures, understanding how the process works, how it actually works. Then, looking at what controls do we have in place, and then coming up with a residual risk to see where we really need to address potential deficiencies. So let's move to the next slide. All right, so tracking. So I think I just touched on that, but you can't know how you're doing in the various areas of servicing if you're not tracking what is happening and recording what is happening. So for instance, fee waiver requests. So I know that's a big deal with the regulators. So you need to document, well, why did you waive a fee? Hopefully you're doing it, in conjunction with your policies and procedures, but you need to have that documentation. Also on your customer service and collection interactions, documenting if there are any special circumstances or what the particular outcome with those conversations were. Incomplete loss application. So what have you done to try to get to the borrower to complete these? Why were they not completed? That type of thing. And of course, your last minute decision. So definitely, document that. As really you would if you're underwriting a loan, which you essentially are. And then consideration of loss mitigation application. So this one here, I think, is interesting. How does the borrower know they have loss mit options, or do you tell them? Is there a borrower who's always like in a specific situation that you offer that loss mit, maybe something you want to look at, or it's a possibility? So that's definitely important to look at. Exceptions, of course, we've touched on that. Exceptions allow discretion, and really in a big way, that's what fair lending, fair servicing is all about. And then GMI, so we did touch on that also. If you're servicing your own loans, it's pretty easy. If not, then you may have to find some alternative ways to make the best approximation of the race, ethnicity, and so on of the particular borrower. And with that, I think, Scott, you're next.
I am, yeah, for the next slide. Thanks, Jerry. And again, I think there's so many important points that you shared with everyone just now. A couple of things that I just wanted to add some thoughts to quickly is, obviously, we've talked a lot about exceptions. And one of the things you just mentioned a couple of minutes ago is, how does your exception process work at your organization? For example, you mentioned if the borrower requests one themselves, right? So if they call in and maybe they missed a payment and there's a late fee on it, if the borrower says, can I have my late fee waived? And for example, if your policy at your shop is we would waive a fee for a borrower, if it's requested by them, it hits to right what you just said, I think 30 seconds ago. How would a borrower know that, right? How would they know that? And for example, would you have one representative over here telling the borrower, we could do this for you if you want one time, and then another rep over here not saying anything, right? So the first thing is, what do you want your policy to be, right? And the more you allow it to be out of your control, sort of, for example, like only if a borrower requests it, the more you could end up in situations where you have different results, right? And so again, I think it goes back to the point, Jerry, that you covered way towards the beginning, which is clear and consistent policies and procedures. Secondly, just want to add a little bit to what you talked about the government monitoring information. And you're so right. If you're servicing loans that you yourself originated, then hopefully you have all the data, right? For the loans where it was provided by the borrower, that you would have it. For the loans where they've been transferred to you from some previous servicer, we know there's the rules that the previous servicer is supposed to provide all of the data that they have for that loan, since the time they've had the loan. But you're right, that servicers don't always get that, right? So what does that mean? If you might not always have the data for loans that you took on that were transferred to you from someone else, it is all the more reason to make sure your policies for what you do are as clear and consistent and followed the same way as much as possible, right? Because if you might not know that this borrower over here that got a worse outcome was a minority, right? But the borrower might, and if they file, for example, a complaint or anything like that, that you don't want to find out that way, right? And so I think, to your point, the fact that you might not have all the data is all the more reason to try to have as clear and consistent of policies as you can. To that point, for as much data as you have, it provides you as a servicer with the opportunity to perform data analysis. And again, I know Jerry was just mentioning it. This is a way for you to find out what you don't know. And so then you can hopefully only have things that you do know, right? Either we're good, we don't have any issues or any significant issues right now, which I'm sure is the case at Jerry's company all the time, or you know what, there's an issue here, or there might be an issue here, right? So for example, if your data analysis were to show, we looked at all of our loan modification decisions, for example, and the majority group, their applications for loan mods were denied maybe 30% of the time. If you found some protected class where their applications for loan modifications were denied, let's say twice as often, 60%, that alone doesn't mean that that servicer is necessarily discriminating against that protected class. But what it does mean is it's something at which you'd want to take a look, right? And for example, do some further analysis, such as regression. You could take a look into factors that are credit-based, right? Such as the previous payment history or whatever documentation they provided or the income that they have now. Something that would be able to show this was the reason, right? That borrower's loan modification was denied, not because they're a member of that protected class, but there was something about their situation that was different, and just based on their risk, couldn't do a loan mod for that particular borrower. But if you're not tracking or analyzing your data and then looking even down to the file level, if you need to, based on your results, you won't know, right? And to Jerry's point, you won't know what your risks are. So there's several different ways that you could be analyzing your data. And I think we've touched on all of these. So number one, your loss mitigation applications, right? How are you dealing with those incomplete applications? What is your data showing you? Is everyone being treated the same? What are the decisions, right, for loan modification? Are they approved or denied? And on what terms are they approved? So for example, that's another way, even if borrowers both were approved for a loan mod, if they were in similar situations and one got more favorable terms than another, that's something you'd want to know as well. And then also the outcomes. What does your data look like for outcomes that were home retention, kept the borrower in the home, versus outcomes that were not, right? Short sale foreclosure. And what is your data telling you? So with that, I think we can go to the next slide, which is, I think, back to you, Jerry.
Yep. Okay, thank you, Scott.
Yeah.
Yeah, so we're just going to talk here briefly. I think Scott covered a lot of this very well, is about doing analyses and testing, which is kind of my favorite thing to do. I'm not the speaker that Scott is, so I just sit and, with my numbers and my spreadsheets, and I'm a happy man. So initial analysis, so, you can look at differences between different prohibited bases. So basically, usually you have, white as your control group. If you're testing for gender, male as your control group, and so on. But you can look at, different aspects and outcomes, such as for incomplete applications, so percent completed versus closed. If you're measuring how you're considering applications received while in foreclosure, and also following where those applications, end up. So that goes to decisions. Are you granting more loan modifications to a certain group than not? Are the terms different? Are you giving greater percentage in lowering the rate to one group or another? There's all sorts of stuff you can measure, depending on what data you have. And of course, the big one, what's the ultimate outcome? So, is there retention? What did end up in foreclosure? Short sell, that type of thing. So you can test those, and they're pretty simple comparisons, and just measure basically averages and see if they're statistically significant. There's a statistically significant difference between them. Sometimes if you have a very large servicing portfolio, even a very, very, very small difference will be statistically significant. So you could adopt kind of a material threshold into that also, but you got to be careful with that. Because there's really no strict regulatory guidance. They would say there really is no material threshold. So statistically significant is kind of, what the regulators are going to look at. And, beyond the initial analysis, as Scott alluded to, you can do regression analysis. So if we can move to the next slide. And so this really helps you understand why you may, have a particular issue if you do, or explain it. So it will account for factors, that may account for the difference in one group versus the other, that, are maybe factors out of your control, or, factors that are kind of quote unquote legit factors. So, Scott talked about payment history, that type of thing. One thing, you can definitely look at is product type, because you're going to see different, different delinquencies and foreclosures rates between FHA and conventional products. So I think that's a big one. LTV, that type of thing. And a lot of times that will really explain the difference where it's no longer statistically significant. And another thing, also, kind of going old school, or match pair comparative file review, which, if you're looking at outliers, that can definitely provide a lot of information on, why would you have these outliers in the first place? And I think a lot of times those, can even go back to training. There's certain people you will find have these outliers that just don't understand the process, or, are doing something wrong that they need to be trained on. So testing, you can test all sorts of stuff. I mean, you can test, if you have the information, your outbound calling initiatives, how many times you're calling people, or how often, all sorts of things. So with that, I think we can go to the next slide.
Yeah, thanks, Jerry. And you're so right. The more you're able to test things, the more you'll know, right? And to know where your issues are coming from. And that point you made just right near the end about outlier loans and what information you can get, I would have said exactly the same thing. That can really tell you if there might be an individual employee, or perhaps some employees, plural, that might not know what the right process is, or might be following a different process, which can lead to those results. So lastly, I think this is my last slide, and then Jerry's going to have one more slide, and we'll wrap this webinar today, is something we call corporate governance, which is all of these things we've talked about, the policies and procedures you have, the actual practice that's going on with your folks servicing loans for borrowers, any data analysis you're doing. What do you do with all of it? And so that's where the corporate governance comes into play. And one of the best things to do, and what I think, for example, the CFPB would be looking for, is, do you have a committee to discuss all of these things, right? So for example, is there a place where Jerry could go and say, you know what, here's all the data analysis we've done over the last quarter, and either we're all good, right? Or we think there might be an issue over here with this process or policy. It's having an effect, unintended as it might be, on a particular group or groups of folks. So we might recommend a tweak or a change to a particular practice or process that we have that would hopefully mitigate or eliminate those potential risks. Or just, as Jerry mentioned, your data is showing that one particular group is not getting as good of results, right, as either the majority group or maybe as any other group. And it would be the kind of thing where you'd say, we just want to take a deeper look at this, right? And at least see what are the ways we could explain it, as Jerry mentioned, based on maybe any of those credit factors that we talked about earlier. And so, for example, we're recommending on a regular basis, such as a quarterly basis, a committee or group will meet. And it should include, again, members of a board if you have one, executive management, certainly at the company, where you could talk about things like training. Jerry's mentioned training a couple of different times over the last hour, to make sure people are taking the training, that it's job specific, and that people are passing any test at the end and they're doing those trainings timely, and that it's being reinforced on an annual basis. And as much data analysis that you're doing, that those reports are shared. It's one thing to do all the reports, but they need to be shared so that people can have visibility on that within the organization, especially if there are any issues that might be worth looking into. And then, of course, if there are any issues that might be worth looking into, then to have an action plan for those, so that, again, it can be reported back yet this is in progress, right? We're working on it. It's either on track or it's off track. If it's off track, we might need more resources. And then to make sure your policies and procedures, your system controls are looked at and updated and reviewed at least annually or as needed if some law or regulation changes. With that, Jerry, I know we have a few minutes left. I'll turn it back to you, I think, to finish up.
All right. Well, this is the last slide, and it's just a quick recap here. So, of course, you have a fair lending program, includes servicing in it. It's part of your whole, CMS, a vital part of that. Training. So we touched on the, importance of that, incredibly important. Discretion. Identify where you have discretion and then test. P&Ps, and I think states here very, what is very important, that they're clear and easy for employees to follow. Something's too confusing, then it's just going to lead to issues. And then lastly, the data analysis, and as Scott referred to, share it with, the highest levels of management. That's what, the CFPB expects. So, you may want to set up some certain type of, committee or something, fair lending servicing committee, that type of thing, where you can share your results and discuss any issues. So with that, I saw Susan just popped up.
Yeah, thank you both so much for that presentation. A lot of great information shared. I think wrapping up, when you're mentioning, Jerry, great to make sure that the highest, level of management at your company is aware of where you are with compliance. If you feel like there's any things that need to be changed or amended in your P&Ps, I think those are all really, great ways to, be thinking about moving forward with this. We did have at least one question that's posed in the Q&A dialog box, so I'll read that off to you guys. But for those of you that are participating, if you have a question for Scott or Jerry, please type that in the Q&A dialog box, and we will go over those now. So the first question says, it used to be that servicing personnel did not have access to GMI info. Are you suggesting now that servicers should have access to that and consider it as part of their servicing?
Scott, I don't know if you want to answer that. I can say, if you're servicing your own loans, you should definitely have access to that. Just go to your origination system, and you should be able to pull out that information. But as Scott alluded to, if it's servicing that's transferred from another company, you may not have the information. I know many a time that information is, for whatever reason, not sent over. So if that's the case, then you may have to use some alternative method to try to identify that. Scott, you have anything to add?
The one thing I would add, Jerry, is, and Susan, is the data is important to have so that you can perform the data analysis and so that you can track issues and discover if there might be any policy or practice or procedure that the company is doing that might have a potential impact, unintended as it may be, on a particular protected class. And if you don't have the data, then you won't be able to know if there's something that's affecting a particular group. As far as a particular customer service representative, for example, having access to the data, or what might they do if they knew, for example, the race or gender or ethnicity, that gets back to what a company's policies and procedures are, right? If your policies and procedures are clear, easy to follow, consistent, then from the rep's perspective, it wouldn't matter if they knew what the person's race, ethnicity, or gender was or not. But from the company's perspective, it's really important to have that data so that it can be part of your data analysis, so that you'll know if there's an issue worth looking into more.
Yeah, and Scott, you can limit that data to,
right,
your fair lending or compliance team members. So it doesn't have to be out there where everybody can access.
For everybody, sure.
Okay, all right, great. Thank you, gentlemen. That is the last of the questions that were posed, other than just compliments on a great presentation and great content. So Thank you both for being a part of this month's compliance webinar. We will have our next month's presentation will be on May 26th. How to slay the social media dragon we had talked about in our prep call. So Melissa Thomas of Active Comply will give a great presentation on this. For those of you that joined us at our legal issues conference, she participated, did a fantastic job. So be sure to join us next month for that webinar. One last thing, if you received this invitation for today's webinar from a colleague in the industry and you'd like to be added to our email distribution list, please email us directly at membership@cmba.com, and we'll be sure to add you to the list. That's it for today's presentation. Thank you both again for your content today. Thank you all for joining us, and we'll see you in May.
Okay.
Thanks for having me. Thank you.